There is a threshold beyond which economic systems do not recover gracefully. Most observers treat geopolitical escalation as a political problem. It is not. It is a structural problem with measurable economic consequences that compound in real time. The difference between contained conflict and system-wide escalation is not a matter of degrees, it is a matter of phase change. Once certain thresholds are crossed, once energy infrastructure becomes a target, once trade corridors close, once capital flight accelerates, the system responds not with adjustment but with dislocation. History shows us this pattern repeating, but the current global economic architecture makes it faster and more severe than ever before. For the past 30 years, the global economy has operated on an assumption of relative stability in major conflict zones. Supply chains were optimized for peace. Energy markets priced in continuous access to reserves. Currency systems settled billions in trades daily on the assumption that institutional frameworks would hold. Developing nations built entire economic models on the expectation that global capital would remain available and that shipping lanes would remain open. This was not naive. It was rational. The cost of redundancy, of building economic resilience, of maintaining strategic reserves is high. Nations and corporations chose efficiency over security. The system worked because no one seriously tested it. That assumption is now being tested in real time. Small conflicts do not break these systems. Contained ones, understood by all parties as finite and bounded, allow markets to price risk and adjust. But escalation, genuine escalation, not political theater, means something different entirely. It means the assumptions underlying decades of economic integration begin to fail simultaneously. The modern global economy is built on three interlocking systems: energy flows, supply chain continuity, and financial settlement. They are not independent. Disruption in one immediately cascades into the others. Energy prices rising spike input costs across all manufacturing. Supply chain disruption means inventory shortages, which means production stops, which means unemployment rises, which means consumer spending falls, which means corporate revenues collapse, which means credit stress spreads through financial institutions. Financial stress means capital freezes, which means governments cannot borrow to manage crisis, which means public spending collapses. These are not theoretical chains. They are mechanical. They are built into the structure of how economies actually function. A major escalation in conflict, one that draws in multiple powers or one that targets critical infrastructure, immediately creates uncertainty about energy supply, not theoretical uncertainty. Specific, measurable uncertainty about whether energy will be available at any price. When energy becomes uncertain, every corporation that depends on energy, which is nearly all of them, must make decisions under duress. They cannot plan. They cannot invest. They can only hoard. Hoarding is a rational individual response, but it is a collectively irrational one. When everyone hoards simultaneously, prices spike, inventory vanishes, and the system locks. This is what we saw in 2022, but at a smaller scale. A larger escalation would compress this process and intensify it. The shift from contained conflict to systemic risk happens at a specific moment. It is not gradual. It is when major powers decide that containment has failed, when one nation believes another nation is existentially threatened, when defensive alliances activate, when energy infrastructure becomes a deliberate target rather than an accidental casualty, when financial institutions in major economies begin to fail due to exposure to affected regions. We are not yet at this point, but the proximity to this point has changed measurably in the last 12 months. The threshold is not further away, it is closer. This matters because markets and economies do not price in risks that are perceived as distant. They do this very efficiently, but they catastrophically misprice risks that are perceived as unlikely but suddenly become proximate. The moment the perception shifts, and these moments happen faster than institutions can respond, the repricing is severe. There are three specific scenarios where escalation crosses into systemic economic reorganization. None of them are certain. All of them are possible. If escalation leads to sustained targeting of energy infrastructure across multiple producing regions, global energy markets split into regional blocks. Europe, which already lost access to Russian energy, cannot replace that volume through Atlantic trade alone. Asian demand for energy continues rising. Middle Eastern production becomes contested. United States and allied production cannot meet global demand. Energy prices do not rise to equilibrium. They become rationed. Some regions get fuel, others do not. This is not a price problem anymore. It is an allocation problem. The economic consequence: nations and blocs begin to compete militarily for energy access rather than economically. Export controls tighten. Trading relationships rewire. Currencies that were trust-based become commodity-backed. Governments spend heavily on military and energy security. Consumer economies contract because capital is redirected to strategic resources. Inflation becomes structural rather than monetary. Central banks lose the ability to control prices because the constraint is physical, not financial. This scenario creates a multipolar energy system where access determines prosperity more than productivity does. It is worse than stagflation. It is the reorganization of trade relationships under scarcity conditions. If escalation draws in major financial centers, if sanctions expand dramatically, if asset freezes become normalized, if investors lose confidence that capital is safe in any major economy, capital flees to perceived safety. But there is no perceived safety when systemic risk is genuine. Instead, capital flees to physical assets: gold, land, energy reserves, strategic commodities. This creates a spike in hard asset prices that is purely momentum-based. It is not based on production or utility, it is based on fear. This spike attracts speculation. Speculation attracts leverage. Leverage means that when the momentum breaks, the collapse is severe. The banking system, which is built on the assumption that assets hold value, begins to fail when asset values become untethered from reality. Regional banks exposed to affected regions fail first. This spreads, credit markets freeze, governments, desperate to stabilize, inject liquidity, but liquidity does not solve a solvency crisis. It only delays it. Corporate defaults rise, unemployment rises. Governments, unable to borrow at reasonable rates because investors are scared, must either cut spending or print currency. Both outcomes lead to inflation and currency depreciation. Nations that are net savers, those with significant foreign exchange reserves and government surpluses, survive this process. Those that are net borrowers do not. The developed world, which has been a net borrower for 20 years, is exposed to this scenario. It is not prepared for it. If escalation becomes sustained and multi-regional, supply chains do not merely slow, they reorganize. Companies cannot access components from contested regions. They must find alternatives or build domestically. This is expensive. It takes years. In the interim, production capacity falls. This is not temporary disruption. This is structural contraction. Manufacturing capacity that was optimized for low cost and global supply becomes optimized for reliability and regional self-sufficiency. This is less efficient. It means higher prices, lower output, and fewer jobs in manufacturing hubs that were built on global supply chain efficiency. The economic consequence: potential GDP falls across developed economies. Growth does not return to previous trends. It returns to lower equilibrium. This means lower future tax revenue. It means government debt becomes less sustainable. It means consumers with lower future earnings expectations reduce spending. This feeds into lower business investment. Lower business investment means slower technological progress. Slower progress means lower long-term growth. A supply chain shock that lasts more than 6 months does not reverse fully. It leaves permanent scarring. The economy adapts to lower capacity. That adaptation is painful and uneven. Some regions, those that can rebuild supply chains domestically or find new suppliers, recover faster. Others face sustained contraction. The global economy becomes more fragmented, less efficient, and lower growth. Who benefits from escalation? Those who control energy reserves in stable regions, those who own hard assets, particularly land and commodities, those with strong government balance sheets and fiscal capacity to manage crisis. Developed nations with dominant currencies have some insulation initially, but this fades if the crisis becomes truly systemic. Who is exposed? Those dependent on global supply chains, most manufacturing, those with high debt levels and low reserves, those in regions with vulnerable energy supplies, those with savings in currencies that lose value as investors flee, those employed in sectors that require growth to be profitable. Most of the workforce in developed economies falls into this category. Who is unprepared? Central banks are unprepared for inflation that stems from supply constraints rather than monetary excess. Governments are unprepared for fiscal stress combined with capital flight. Corporations are unprepared for sustained supply chain disruption. Investors are unprepared for asset price declines across all categories simultaneously. The consensus expectation is that if escalation occurs, it will be short and contained. History suggests otherwise. Escalations that begin do not always end quickly, and when they last, systems adapt to the reality of conflict, not the hope of resolution. There are thresholds in complex systems beyond which recovery is not automatic. Once the global economy enters a state of regional fragmentation, military competition for resources, and financial stress, it does not return to its previous equilibrium by default. It settles into a new equilibrium. That equilibrium is lower growth, higher cost, and more militarized. Whether this happens depends on decisions made by a small number of institutions and leaders in the coming months. Those decisions are being made under incomplete information, competing incentives, and time pressure. This is not a stable environment for wise choices. What happens next is open, but the range of possible outcomes is not wide. It is narrow, and most of them are worse than the baseline expectation that guides current policy and investment.